and welcome to the latest edition of Citrus Bites. For as long as I can remember, during these editions, I've been talking about inflation, interest rates, and the story has really been about when are we going to see some move downwards in interest rates. As we got towards the end of 2023, it felt like that was reaching a crescendo. Predictions of many reductions, both in kind of Europe, the US, and also in the UK, actually, as we headed through 2024. Here we are, we're nearly in June, and so far, no reductions. But economists up until now, according to Reuters, have been polling that about 50% were forecasting a reduction in the Bank of England base rate in the June monetary meeting, which is due on June the 20th. So today I'm going to talk through the latest results. Actually, interestingly, the European Central Bank are meeting in a couple of weeks. The Federal Reserve in the US, their central bank, they're meeting 3 weeks, and the Bank of England are 4 weeks. So we are about to enter a really peak level of activity for central banks to see what they intend to do about interest rates. So let's have a look at the latest results that came out this morning for UK inflation. So you can see 3 lines on this particular graph. The first one, the blue line is CPI. And the great news is that's gone down to 2.3% on a year-on-year basis. And that's against 3.2% and the last update. So some really good downward movement being seen here. Some of you may have heard Rishi Sunak going on saying, you know, the plan is working. Well, actually, this was pretty much forecast, I hate to say. Not only was it forecast, but actually, according to Reuters, who did a poll, they were forecasting even a slightly lower number of 2.1%. And the reason this was forecast is a big chunk of this drop is down to the Ofgem energy price cap change that came into effect in April. And the difference that made, typically, and I hate to use averages, but that's the way it's stated, for an average consumer paying by direct debit for their energy, they saw a reduction of about £230-ish for the year coming in their energy, and that has filtered through to the CPI number. Not quite so encouraging, however, is green with the line here, which is core CPI. And I've been talking about core CPI for those of you that follow Citrus Bites month on month now, and saying that was where I was kind of most nervous. And as you can see, core CPI is down to 3.9% on a rolling basis. However, forecasted again had polled that it would come out lower. It's down from 4.2, but that sticky inflation I'm going to talk about again in a second is proving to be a challenge. And don't forget that blue of 2.3%, it's really the Bank of England, that's the figure they're using to say really their inflationary goal is to get it down to that 2% mark. So we're not there yet because it's still at 2.3. And I know it feels really close, but actually it's still quite a big gap. And the last line I'm going to talk about briefly in a moment is the services inflation, which goes into the inflation data. But I've pulled it out as a separate story today because I think it's one that's worth talking about for a moment. Before I get to that and explain why is that proving so stubborn from a services inflation perspective, I just thought I'd answer a question about, so what goes into the CPI number? That people hear about this basket of goods and go, well, actually, what is this virtual basket of goods? And does it apply to me? Is it a good reflection of what I tend to consume? So there's been some change. I'm not going to talk about everything. I'm going to talk about what's changed in it for this year, which is quite interesting. So this should, in theory, reflect the changes in consumers' behavior. So into the metrics in 2024 become air fryers, vinyl records. There we go. Who knew? Back in rice cakes, spray oil, and gluten-free bread. So an interesting mix of products that's now entered our CPI inflation calculations. However, some have gone out. So hand sanitizer, for those of you that remember during COVID, obviously the search for hand sanitizers, sofa beds are out, rotisserie chickens of all things are out, and bakeware seems to have gone out as well. And I just thought I'd cover that briefly. So this is always changing. These goods that go into this basket of goods that help calculate the CPI does change quite regularly. So I'll try and bring in those regular updates, and you'll be able to know whether that's a really good reflection of you as a consumer. Typically, are you the person that goes, yeah, I've bought an air fryer, love my air fryer, and vinyl, I'm back on vinyl, etc. But again, what it goes to show is inflation is probably very different to each of us based on what we consume. So back to services inflation. I've been speaking for quite a while on Citrus Bites around average weekly earnings and unemployment. And the reason services inflation is so important in the UK is because it makes up such a big part of our economy. So any stickiness around the services inflation is going to cause a concern, and that is exactly what we're seeing. So why are we seeing that? Well, typically wages is a really big driver, and the reason rather wages are a big driver is because that gives consumers spending power. And actually, the services inflation information is broken down quite a lot. And the area that seems to be really driving the services inflation still is eating out. So eating out in hotels are a big part of it. Interestingly, therefore, there's a bit of a clash between air fry seemingly going into the CPI calculation, and yet, in theory, a lot of people seem to be still eating out. And that is going to cause Andrew Bailey, as the governor of the Bank of England, a real concern. Because one thing he does not want to do, and when the MPC vote for this on the 20th of June, they do not want to drop interest rates just to have to put them back up. And of course, they should only drop interest rates, the Bank of England base rate, if there is a real need. And right now, some of these spending patterns are still running really, really high. So what's driving the next step will be, well, how come that wage inflation, the earnings piece is still there? Why are they still rising the way they are? And typically we would look to that labor market pressure. So if there's too many jobs, not enough people to fill those vacancies, obviously that creates a tight labor market. It drives up the price to recruit and retain top talent. Now, what we are seeing, although we're seeing a slight uplift in unemployment and the number of vacancies are going down, so I think the most recent figure is below 900,000 now for vacancies. It's continued to go down for, I think, about 22 consecutive reporting periods, but it's still quite stubborn. It's down 17% or so on a year-on-year basis. But that 900,000 is clearly still causing a real pressure on those average earning increases that people are seeing. And of course, that is ultimately enhancing people's spending patterns. So in spite of all the rhetoric around, mortgage rates, and in the UK, such a large percentage of UK borrowers with mortgages are on short-term fixed rates, 2 years, 3 years, 5 years, we're still spending kind of in a way with the average earnings going up the way they are. So I think as it stands, you may remember I spoke to you last month about stick or twist if you watched it. And I said, that's really where we're at right now. What's it likely to be? Well, I'm going to talk about my two horses, stick and twist. And I think when I spoke to you last time, I think twist, which would be a rate reduction, was marginally in front. I have to say at the moment, having jumped the final hurdle, they're going into the home straight. It feels like stick is probably back in the lead. And that's what Reuters are saying. They're getting a poll from investors now saying that from 50% this morning that predicting a Bank of England rate reduction in June, that probability has gone down to 15% now. So clearly a much greater view that rates are going to stay as they are when the Bank of England meet again in June, on the 20th of June. However, before we get there, there's another inflationary data set due to come out on the 19th of June. So I'm going to speak to you again at that time and go, look, what are we seeing and how likely is this? But it's not over yet. There is still a chance that the numbers could look good enough when it comes to the 20th of June that the Bank of England still do decide to make a change. But today, when I'm reporting to you, that's what's currently being seen. And the other thing I spoke to you about last time, and it's never, data is one story. So amongst that, there's all this political and geopolitical unrest that's going on. There's elections in the UK due at some point, elections in the US. And I talked last time about the geopolitical tensions, particularly in the Middle East. I also talked about the threat of oil prices. And I just thought I'd check back in and see, well, what have we actually seen with oil prices? Well, as you can see from the graph, oil prices, thankfully, have come back off their high, but they are still elevated if you look back on a more trended basis over the last 12 months. So for those of you saying, well, hang on, yeah, oil prices might have come off their high, but my price I'm paying at the pump, for those of you that use that, is still going up. Yes, you're right, because this is still above where those figures were. So thankfully, oil prices coming off slightly. Unfortunately, we're still experiencing a little bit of that pressure come through to the pumps. And that geopolitical tension is going to be one of those things that just plays out over the coming weeks and days and months. And obviously I'll report and say, well, what sort of impact is it having, not on the human bit, I'll tend to report on the economic bit. So there we go. An awful lot of information I've talked about today. I hope it's been useful. The next 4 weeks feel absolutely vital, is what I would say. So historically, it's always the Federal Reserve in the USA that have gone first with an interest rate move, whether that be up, whether that be down. Andrew Bailey, the governor of the Bank of England, he recently came out and said, well, there's no rule that says it has to be that way. The first one that's going to be really interesting is the European Central Bank on the 6th of June when they report, because they have the chance to prove that it's not just about America. And actually, they could indeed come out and make a change to their own rates, which would be interesting as a precedent before it gets to the Federal Reserve meeting, and then again for the Bank of England one on the 20th of June. So that's it from me. I look forward to updating you on exactly what happens next month. Until then, take care and bye for now.